If I asked you what the most important piece to a successful retirement is, what would you say? Maybe you tell me it's how much money you have or what investments you hold in your portfolio. Now, those are great answers, but after 20 years of working with retirees, I'm going to tell you something very counterintuitive. Some of the biggest financial outcomes in retirement have very little to do with your portfolio. Today, I'm going to walk you through 5 decisions that in fact often have a bigger impact on your retirement than the investments you choose. I'm Jared Kinney, Wealth Advisor with the Noble Group. Let's start with a big one, where you choose to live. Housing will be one of the largest expenses you'll face, and even small differences in cost of living can add up dramatically over time. Think about property taxes. In some states, they may be a few $1,000s per year. In others, they can easily reach $10,000 or more. Healthcare costs can vary depending on where you live. The cost of homeowners insurance and car insurance can vary widely. Everyday expenses like groceries, utilities, and transportation can look very different depending on the area. Now, you may decide to downsize. You might decide to move to a lower tax state. Maybe you'll decide to relocate closer to family. Each of those decisions can reshape the financial picture of your retirement. Let's say you relocate and you're able to reduce your housing costs by $1,000 per month. That'll create $12,000 of annual cash flow. Over a 25-year retirement, that is $300,000 of additional spending power. That impact is huge and can easily outweigh the difference between one investment portfolio and another. The next decision is your healthcare strategy. Though healthcare is up there with housing as one of the largest expenses many retirees will face, it's often one of the least planned for. Between Medicare decisions, supplemental coverage, long-term care considerations, and potential out-of-pocket expenses, there's a lot to try to keep track of. If you're retiring before 65 and not yet eligible for Medicare, you'll need to think about the cost of private insurance, and those costs are often substantially higher than Medicare. But making thoughtful decisions about coverage, timing, and potential risks can help reduce financial surprises later. Ignoring healthcare planning can lead to unexpected costs that can disrupt otherwise well-designed retirement plans. So think about what expenses you might run into when it comes to your health and retirement. Figure out what you can do to safeguard your portfolio from those potential expenses, because even a well-kept portfolio is no match for a poorly planned healthcare strategy. The next important decision is your Social Security strategy. Now, I'm sure you're already aware that Social Security timing shouldn't be taken lightly, but I want to emphasize just how important it really is, because I see many people treating it like a simple switch they flip on at age 62. Now, don't get me wrong, there can be a lot of really good reasons to take Social Security at 62. In fact, I made a video explaining the 5 best reasons that I'll link at the end of this video, but it's not a one-size-fits-all decision that works for everyone, because the age at which you claim will dramatically affect how much income you receive over your lifetime, and it could also determine how much your spouse will get if they outlive you. By taking Social Security early at 62, your monthly benefit will be permanently reduced. If you wait until full retirement age, those benefits can increase substantially. And if you delay until age 70, those benefits can be even greater. In many households, Social Security ends up being one of the only sources of guaranteed lifetime income. That means claiming strategies can influence not just income today, but income for the rest of your life and potentially your spouse's life as well. Choosing the right timing can easily add or subtract tens of thousands of dollars over your lifetime. And if your portfolio can support your income needs in the first years of retirement, claiming later for a larger benefit can oftentimes be a wise move. And that has nothing to do with picking the perfect investment fund. The fourth important decision is related to your portfolio and your investments, but it's not about what you do with them while they're in those accounts. It's the order in which you withdraw that money when you need to use it. You probably have money in quite a few different places: traditional IRAs or 401ks, taxable brokerage accounts, or Roth accounts. Each one has a different tax treatment, and the order in which you withdraw from them can affect how much in taxes you'll pay each year. For example, withdrawing too aggressively from tax-deferred accounts early in retirement could push you into a higher tax bracket. It may also affect how much your Social Security becomes taxable. It can even influence your Medicare premiums later. Decisions you make now can affect your premiums 2 years down the road due to the 2-year look back that those premiums are calculated on. On the other hand, a coordinated withdrawal strategy can help smooth out taxable income over time. It can reduce the overall taxes you pay throughout retirement, and it can potentially extend how long your portfolio lasts. That decision has nothing to do with which stock fund you own. It's solely about strategy. The final decision is how you choose your retirement lifestyle. I know this may sound obvious, but one of the biggest drivers of your retirement success will be spending. Your lifestyle choices determine how much income your retirement plan must support. The difference between spending $60,000 per year and spending $100,000 per year is enormous when you stretch that over a 30-year retirement. Making a smart lifestyle spending decision in retirement often comes down to the willingness to be flexible. Market returns are not always predictable. Inflation is not always predictable, but your spending choices are something you can control. Some retirees naturally adjust spending as circumstances change. Others maintain rigid spending habits even when conditions shift. The retirees who maintain flexibility tend to have far more resilient retirement plans. So yes, your portfolio matters, but how you choose to live matters even more. Now, there's one more decision that can build confidence in your retirement picture, and that's having a plan. Click the link in the description or scan the QR code on screen to schedule a free retirement review with us and start building a plan personalized to your assets, your goals, and your lifestyle. And if you learned something from this video, click the like button and subscribe to keep up to date with our weekly content. Thanks for watching.